Ever feel like you're just drowning in data when you're trying to figure out what's really going on with the company? We've all been there, right? Sifting through reports, trying to find the actual story. But what if you could get that deep understanding, quickly? Well, that's exactly what we're aiming for today. Welcome to the deep dive. Our mission here is to really unpack the latest Q1 FY26 results for Bharat Parenterals Ltd. That's for the quarter ending June 30, 2025. We're going to break down the key numbers, look at the strategy behind them, and explore where they might be heading. We've got the latest investor presentation, the official board meeting notes from July 28th, and actually a set of financial review questions that help shape this whole deep dive. It's quite a story of change. So let's jump in. When we look at Bharat Parenteral's quarter overall, what's the big picture? Where do we start?
Well, the really fascinating thing and where you get the real insight is looking at their standalone versus their consolidated figures. It's quite a contrast. Think about this. Standalone is the core listed company, BPL itself. Consolidated pulls in BPL plus all its subsidiary businesses. And right away, you see how important those subsidiaries have become. So for the standalone performance, just BPL revenue from operations hit 94.37 crores. Now, for context, a crore is 10 million Indian rupees, so about what 1.2 million US dollars maybe. So that revenue is around 11.3 million USD. That's up about 2.5% year on year. But interestingly, it's up a lot from the previous quarter, 17.6% sequentially. So strong rebound there in the core ops. Their EBITDA, operational profit, that was 15.4 crores, up just under 3% year on year. But again, that sequential change from Q4, massive, up 235%. So a big efficiency gain this quarter in the core business. EBITDA margin held pretty steady, around 16.3%. However, and this is key for standalone, the net profit PT actually decreased it down almost 18% year on year to 10.0 crores. And that pulled the earnings per share down too naturally.
Okay, so standalone, decent revenue rebound sequentially, strong EBITDA jump from last quarter, but weaker profit compared to last year. Got it.
Exactly. Now, switch to the consolidated performance. This is BPL plus the subsidiaries. Here, revenue from operations was 116.00 crores. That's a much stronger 25.4% year-on-year increase and still up sequentially about 11.6%. Total operating revenue also saw strong growth, 23.2% year-on-year, and the consolidated EBITDA, it soared, up almost 207% year-on-year to 13.78 crores. That pushed the consolidated EBITDA margin up dramatically from just 4.9% last year to 11.9% this quarter. But probably the biggest news on the consolidated side, the net loss shrunk massively. It improved by over 90%, going from a loss of 8.85 crores last year to just 0.86 crores this quarter. A huge improvement. And that, of course, improved the consolidated EPS quite a bit from a loss of Dyna's of 14.7 to just 1.27.
Wow, okay. Those are stark differences. You see the core company's profit fall, but the overall group loss just shrinks away. So what does that tell us? It really feels like the subsidiaries aren't just contributing, they're fundamentally changing the group's financial picture, especially cutting those losses, right?
You've hit the nail on the head. That's exactly it. The consolidated numbers really show this strategic shift happening within the BPL group. It's not just the holding company anymore. It's the combined power and the very different roles of its three, well, technically four parts if you count the core BPL separately. These aren't just add-ons, they're strategic pillars, each doing something specific. So first, you still have Bharat Parenterals PVT Ltd, standalone. That's the original business, the export-focused pharma manufacturer in Vadodara. They do the finished dosage forms, FDFs, things like anti-infectives, anesthesia, pain meds, cardiovascular drugs. They've got a wide reach India, Africa, Latin America, Southeast Asia, Middle East. That's the established engine.
Okay, the foundation.
Precisely. Then you've got Inoxal Life Sciences. BPL owns about 56% of this one. And Inoxal is really interesting. It's all about complex specialty drugs for the highly regulated markets, primarily the US and Western Europe. They have a pipeline of over 40 complex products, 12 already licensed out. Big news for them. They passed a US FDA inspection back in May 2025.
That's huge for accessing the U.S. market.
Absolutely. And they've got an EU GMP audit coming up in Q3 FY26. Get this, Inoxal is apparently India's only US FDA-approved facility for making oncology oral liquids, and one of only 6 globally. That's a serious competitive moat.
Wow, okay. So high-tech, high-barrier stuff.
Exactly. Then there's Varenium Healthcare, which BPL owns 100%. This one focuses on branded generics for India's institutional market hospitals, clinics. They're in over 7,500 hospitals across India, including big names like Apollo and Fortis. And a cool fact, Varenium was apparently the first in India to launch Shigamadex, which reverses anesthesia through a joint venture. So they're finding niches in the domestic market, too.
Okay, tackling the home market institutions.
Right. And finally, the newest piece, Varenium Bio Life Sciences. Also 100% owned, set up in 2022. This one's designed to make complex injectables, leveraging Inox's pipeline, but for regulated emerging markets. Think Brazil, Colombia, South Africa, Australia. It's still under construction, aiming to be operational by FY27. So this is an investment in future growth in those far emerging markets.
That's a really clear breakdown. You've got the core engine, the high-tech R&D driver for developed markets, the indie institutional player, and then this new venture for regulated emerging markets. So zooming out again, how does this structure serve BPL's bigger strategy? What's the master plan connecting these?
The master plan is definitely about transformation. It's about diversification, yes, but specifically diversification aimed at driving both top-line revenue growth and expanding margins. Profitability is key. You see that strategic shift away from, say, lower margin anti-infectives towards higher margin areas like critical care and these niche complex products developed by Inoxol. And the focus on countries with tough regulatory standards, the fact they're US, Europe, but also those regulated emerging markets, it's deliberate. Higher barriers to entry usually mean higher potential margins if you can meet the standards, which BPL is positioning itself to do. It's about quality playing into profitability.
Right, moving up the value chain, essentially.
Precisely. And that ties into their operational strengths. They're not just buying companies, they're leveraging what they already do well. They've got deep roots in these high-growth geographies, and they keep upgrading their manufacturing, staying current. Their product pipeline is specifically curated, they say, for growth and better margins, and they highlight these differentiated technologies, liposomal injectables, extended-release injectables, oral solid-to-liquid conversions.
Fancy terms, but what do they mean practically?
Practically, it means they can create drug delivery systems that solve problems. Maybe make a drug last longer, target it better, make it easier to take. Things that meet unmet needs and give them an edge over standard generics. It's about offering something genuinely different and valuable. Plus, they mention the founding team's diverse expertise. R&D, regulatory stuff, clinical trials. Actually selling the stuff acts as a kind of internal risk management. They've got people who understand the whole chain.
That makes sense. Having that internal know-how across the board definitely de-risks things. Okay, so a clear strategy, strong operational focus. Feels like they're building momentum. So what does the road ahead look like? What's management saying about expectations for this fiscal year, FY26?
Yeah, they've given some pretty specific guidance, which shows confidence. They've broken it down by vertical. For BPL standalone, the core business, they're projecting 12-14% revenue growth. And they expect EBITDA margins to improve further, aiming for 15-17%. Steady growth and better profitability there. For Inoxol, the high-tech subsidiary, the target is 70-75 crores in revenue, mostly from licensing deals and milestone payments initially. The big goal for Inoxol this year is hitting operational break-even by year-end. Commercial manufacturing, the CMO supplies, they expect that to start Q1 FY27 after that crucial EU GMP inspection. So this year is about setting the stage for Inoxol's commercial launch.
Right, getting it ready to really contribute.
Exactly. Then Varium Healthcare, the India institutional business, they're forecasting 62-65 crores in revenue. That's solid growth, 20-21% year on year. The longer-term aim there is to hit 100 crores by FY28 by going deeper into hospitals and adding more products. Importantly, they say it's asset-light, so no big factory investments needed there.
Efficient growth.
Seems to be the idea. And finally, Varanium Biolifesciences, the new emerging markets venture. That's still in the investment phase. No revenue expected in FY26. The focus is purely on finishing construction, total cost projected around 120-150 crores, with about 30 crores spent so far, and getting all the regulatory approvals ready for a commercial start in FY27. It's a build year for them.
Okay, so growth in the core, break-even target for Inoxol, solid growth for Varium Healthcare, and build-out for Varium Bio. A clear plan for each part.
Very clear. And management wraps it up by emphasizing their commitment to, and I quote, a disciplined approach towards sustainable and differentiated growth. They're not just growing, they're trying to grow smartly in specific higher value areas.
Makes sense. Now, beyond the numbers and strategy, corporate governance is always crucial. Anything significant from that recent board meeting on July 28th?
Yes, a few key things came out of that meeting, mostly procedural, but important for keeping things on track. First, they formally signed off on the Q1 FY26 results we've just been discussing, both standalone and consolidated. Standard procedure. They also set the date for the 32nd annual general meeting that'll be September 26, 2025. So shareholders will get their chance to engage then.
Right.
There were also some changes on the board of directors. Mr. Sanjay Shah resigned. Mr. Alkesh Jayanthalal Shah was appointed as an additional non-executive, non-independent director, and Mr. Mukesh Bhai Patel was reappointed as a non-executive independent director for a second term. These kinds of shifts often happen as companies evolve their strategy, bringing in maybe different expertise or perspectives.
Aligning the leadership.
Seems like it. And lastly, they appointed new statutory auditors, Ms. Shah Mehta and Bakshi, for both the main company and its material subsidiary. Again, ensuring that financial oversight remains robust. So overall, it looks like standard but necessary governance actions to keep the ship steady and aligned with their growth plans.
Okay, good to know. So let's pull this all together. You've just had a real deep dive into Bharat Parenterals Q1 FY26. We've looked at the numbers, unpacked that crucial difference between standalone and consolidated performance, seen how their group structure is built on distinct strategic pillars. Explored their operational strengths and got a clear view of their roadmap for the year ahead. The big themes: focused investment in complex, high-margin pharma and a strategic push into both developed and regulated emerging markets. Hopefully, this gives you a much richer understanding than you'd get from just scanning headlines. You're now pretty well informed, I'd say, on how this company is navigating the tricky global pharma landscape.
Absolutely. And it leaves us with something to think about, doesn't it? We see Bharat Parenterals making this very deliberate shift towards niche portfolios, specialty medicines, higher margin stuff, while also targeting these far emerging markets. Now, as global healthcare access keeps expanding and there's more and more talk about drug costs and affordability, how do you think BPL's strategy positions them? Focusing on innovation for critical needs, but doing it significantly in emerging markets alongside developed ones. How might that play out differently compared to companies just focused on, say, the US or Europe? What really stands out to you about how they're trying to balance that equation? Innovation, market access, especially in developing economies, and profitability in the years ahead. So something to chew on.